If you or someone in your family collects Social Security, don't scroll past this one. Right now, in 2026, the SSA is applying 4 completely different sets of rules depending on the year you were born. And people in every single one of these 4 groups are either losing money every single month or sitting on a decision they cannot undo. I'm going through all 4 groups today, one at a time, with the exact numbers for each one. Stay with me, because your group is coming up, and by the end of this video, you'll know exactly what to check today. Before I get into the groups, if you haven't subscribed to this channel, do it now and turn on the bell. And here's the actual reason that matters. Social Security rules do not sit still. Full retirement ages shift depending on your birth year. Earnings limits change every single year. Medicare premiums move. Survivor benefit comparisons get revisited. And overpayment policies get rewritten. And the SSA never sends you a personal memo explaining what changed and what it means for you specifically. They update the policy and assume you already know. I've seen people find out about a rule that would have helped them months after the point where it could have actually made a difference, simply because nobody explained it in plain language before the deadline passed. What I do here is take those changes and break them down by exactly what they mean for your birth year, before the deadline passes and before the money is already gone. Every group I'm covering today has something specific happening to them in 2026. The people already subscribed to this channel find out in time to actually do something about it. The ones who aren't find out after. Subscribe, turn on the bell, and let's get into your group. Group 1. Born between 1967 and 1975. You are somewhere between 51 and 59 years old right now. And if that's you, here's the mistake almost everyone in your group is making. You're assuming Social Security is a problem for later. It isn't. What you do in the next few years quietly decides how much money shows up in your account every month for the rest of your life. And most people in this group have never once looked at the actual numbers. Here's your baseline. For everyone born in 1967 through 1975, full retirement age is 67. No exceptions, no sliding scale. It's a flat number. If you claim at 62, the earliest possible age, your benefit is cut by 30%, and that cut is permanent. It does not go back up later. On a benefit of $2,100 a month, that's $630 less every single month for the rest of your life. Stretch that across a 20-year retirement, and you've given up more than $151,000 compared to waiting until 67. Now, flip it around. If you wait past 67, you earn delayed retirement credits, 2/3 of 1% for every month you hold off, which adds up to 8% a year. Wait all the way until 70, and you've added 24% on top of your full benefit, permanently. On that same $2,100 benefit, that's an extra $504 a month, every month, for as long as you live. The SSA will never call you to tell you this. They will process whatever age you tell them, and whatever number comes out becomes your number forever. But here's the part that actually matters most for your group specifically, because you still have time to fix it. Social Security calculates your benefit off your highest 35 years of earnings. If you have fewer than 35 years on record, or if any year in there is wrong, a payroll error, a job that never got reported, a freelance year that fell through the cracks, that mistake is quietly shrinking your future check right now. Each year that's wrong or missing costs you roughly $100 a month once you claim. You are still young enough to have your pay stubs, your old W-2s, your tax returns. Go to ssa.gov, create a My Social Security account if you don't already have one, and pull up your full earnings statement. Go year by year and compare it against what you actually earned. If something doesn't match, file a request to correct your earnings record with the SSA and attach whatever documentation you have. It's free, and it's the single highest leverage thing anyone in this group can do this year. Because in 15 years, finding that documentation will be a lot harder than it is today. There's a second lever in your favor, and it has nothing to do with when you claim. Social Security only counts your highest 35 years of earnings. If any of your early years, your 20s, a stretch of part-time work, a year between jobs, came in low, every additional year you work now at your peak income can quietly replace one of those weak years in the calculation. Say one of your early years shows $18,000 in earnings, and this year, you're earning $95,000. Working through this year alone can raise your eventual benefit because SSA automatically drops the lowest years once you have 35 solid ones on record. It's not dramatic on its own, but stacked over several more working years, it adds up to real money every month for the rest of your life. And if you're one of the higher earners in this group, know that the maximum income subject to Social Security tax in 2026 is $184,500. Anything above that isn't taxed for Social Security and doesn't add to your benefit either, so there's no need to worry about that ceiling. Just make sure the years below it are recorded accurately. While you're in your earnings statement, glance at your work credits too. You need 40 credits over your working life to qualify for retirement benefits at all, and you can earn up to 4 a year. In 2026, one credit requires $1,890 in earnings, so 4 credits, the max for the year, takes $7,560. Most people in this group cleared that bar decades ago without ever thinking about it, but if you had a long stretch of self-employment that wasn't reported properly, or years living abroad, it's worth a 2-minute check to confirm you're not one of the rare exceptions still short. One more thing worth flagging for this group specifically. If you're married, your claiming decision doesn't just affect you, it affects what your spouse could eventually receive as a survivor benefit, since a surviving spouse can step into whichever benefit is higher between the two of you. Claiming early locks in a lower number for both of you if something happens to the higher earner first. It's worth running the numbers as a couple, not just as an individual, before either of you files. Group 2. Born between 1957 and 1966. You are somewhere between 60 and 69 years old, and this is the group where the rules are the most different from person to person, because your full retirement age depends on your exact birth year down to the month, and most people in this range genuinely don't know their own number. Here's the breakdown. If you were born in 1957, your full retirement age is 66 years and 6 months, and claiming at 62 cuts your benefit by 27.5% for life. Born in 1958, your full retirement age is 66 years and 8 months, and an early claim costs you 28.3%. Born in 1959, it's 66 years and 10 months, with a 29.2% reduction. And if you were born anywhere from 1960 through 1966, your full retirement age is a flat 67, and claiming at 62 takes a full 30% off your check permanently. That's not a rounding difference. Put in real numbers. Someone born in 1957 who claims at 62 on a $2,200 benefit collects about $1,595 a month for life. Someone born in 1960, same $2,200 benefit, same age 62 claim, collects about $1,540 a month for life. Same starting benefit, same claiming age, $55 a month apart, purely because of a 3-year gap in birth year that most people never think to check. This group is also where most of the actual claiming decisions are happening right now, in real time, which is exactly why the confusion in this group costs the most money. A 1-year mistake in a group that's decades away from claiming is easy to fix later. A 1-year mistake in this group is often already locked in. If you're past your full retirement age and still haven't filed, every month you wait adds 0.2% to your check, permanently, up until age 70. Depending on your exact birth year, that adds up to somewhere between 24 and 28% more for life. On a $2,200 benefit, that's up to an extra $610 a month, every month for the rest of your life, just for waiting. And if you're in this group, working and already collecting Social Security before you've hit full retirement age, the earnings test applies to you, and this is the part that confuses people the most. In 2026, if you earn more than $24,480 for the year, the SSA withholds $1 in benefits for every $2 you earn above that limit. In the actual year you reach full retirement age, the limit jumps to $65,160, and the withholding drops to $1 for every $3 over, And it only applies to your earnings before the month you turn full retirement age. Once you hit full retirement age, the limit disappears completely. You can earn anything and keep every dollar of your benefit. Here's the part almost nobody explains to people in this group. That withheld money is not gone. Once you reach full retirement age, the SSA recalculates your monthly benefit to credit you back for those withheld months. But if you don't know that going in, watching a chunk of your check disappear feels like a penalty instead of what it actually is, a temporary hold. There's a special version of this rule for the calendar year you actually retire, in case you don't work the full year. SSA can apply a monthly earnings test instead of the annual one, so a big paycheck from January doesn't wipe out your benefit for the whole year, as long as your earnings drop below roughly $2,040 a month for the remaining months, or $5,430 a month in the year you hit full retirement age. Almost nobody in this group knows that rule exists, and it can be the difference between getting your first several checks or losing them to the earnings test unnecessarily. If you're married and in this group, there's another number worth checking before you file: your spousal benefit. A spouse can claim up to 50% of the higher earner's full retirement age benefit, even if that spouse never worked a single day or worked at a much lower income. If your own benefit is smaller than half of your spouse's, filing on your own record instead of checking the spousal option is a mistake. SSA will not stop you from making. Ask them directly to run both numbers before you file, exactly like you would for a survivor benefit. SSA.gov also has a free retirement earnings test calculator and a retirement age calculator that run your exact numbers in a few minutes, based on your real earnings history, not a rough estimate. If you're anywhere close to a claiming decision in this group, use them before you call SSA, not after. Before I get to the next group, I have to tell you about an email that landed in my inbox this week, because it connects directly to what's coming up. A viewer wrote in, I'll just call her Diane, confused about why her monthly check had stayed exactly the same for 6 years, while her younger sister, also a widow, was suddenly getting $400 more than her every month. Both women worked similar jobs their whole lives. Both lost their husbands around the same time. Diane is 73, lives outside Columbus, and had simply assumed her check was naturally lower because of how her own career played out. It never once occurred to her there might be a fix sitting right there. I dug into what SSA actually does in cases like this, and I'm going to tell you exactly what I found and how her story ends before this video is over, because the answer applies directly to the next two groups I'm about to cover. Group 3. Born between 1952 and 1956. You are somewhere between 70 and 74 years old, and if you're in this group, there is one thing that is more urgent for you right now than for anyone else on this list. Delayed retirement credits stop accruing the month you turn 70. That's not a soft cutoff, it's a hard one. If you were born in 1952, 1953, or 1954, your full retirement age was 66, and you have already been eligible for maximum growth on your benefit for years. If you were born in 1955, your full retirement age was 66 years and 2 months, and 1956, 66 years and 4 months. Every single person in this group has already turned 70 or is turning 70 this year. So if you're in this group and you still, for whatever reason, have not filed for Social Security, stop waiting. There is zero additional benefit sitting out there for you anymore. Every extra month you delay past 70 is not earning you anything. It's just money that isn't coming in. If you're 72 and still haven't filed, waiting even one more year doesn't add a single dollar to your benefit anymore. It just delays money that's already sitting there, waiting for you. On a $2,300 benefit, that's $27,600 a year, unclaimed for no additional reward. File now. The second thing, and this is exactly what happened with Diane, is making sure you're actually collecting the right benefit. A significant number of widows and widowers in this age range are collecting their own retirement benefit when they would receive considerably more on their late spouse's record, or the other way around. A survivor benefit can pay up to 100% of what your deceased spouse was receiving, and in a lot of cases, That number is meaningfully higher than what the surviving spouse gets on their own work record. If you lost a spouse and you have never specifically asked SSA to compare both numbers side by side and put you on the higher one, there is a real chance you have been leaving money on the table for years, sometimes decades. Call SSA directly at 1-800-772-1213 and ask them specifically to pull both figures and compare them for you. The third thing is Medicare. In 2026, the standard Part B premium is $202.90 a month. If your income was higher in 2024 because of a one-time event, selling a property, a Roth conversion, a big withdrawal, Medicare is charging you extra right now in 2026 based on that old number because of a 2-year look-back rule. That surcharge, called IRMAA, can add anywhere from about $81 to nearly $490 on top of your regular premium every single month. If your income has dropped since that one-time event, or if it was never supposed to be that high to begin with, you can file Form SSA 44 with SSA and request a recalculation based on your current lower income. Most people never even find out this form exists. If anyone in your family in this age range is still working past 65 without employer coverage and never enrolled in Medicare Part B, there's a permanent late enrollment penalty sitting on their premium, an extra 10% for every 12-month period they went without it. That penalty doesn't expire. It applies for as long as they have Medicare. If that describes someone you know, there's a limited enrollment window each year to get covered and stop the penalty from growing further. And it's worth checking sooner rather than later. Every December, SSA mails out a COLA notice showing your new benefit amount for the coming year. It's worth actually opening that letter instead of assuming the number is right. Deduction errors for Medicare premiums, garnishments that should have ended, or an old address routing mail somewhere else, these show up in that notice, and catching them early saves months of back and forth to fix later. It's also a good moment to make sure the basics are current. Direct deposit information, mailing address, and the trusted contact listed on your My Social Security account. None of that is exciting to check, but when it's wrong, it's usually a family member who ends up untangling it months later, not the account holder. Group 4. Born in 1951 or earlier. You are 75 or older, and by now you've likely been collecting Social Security for years, maybe decades. That does not mean there's nothing left worth checking. The survivor benefit issue from the last group applies here too, and honestly, it applies more, because the longer someone has been on the wrong benefit, the more money has quietly slipped by. If you are a widow or widower in this group and have never had SSA directly compare your own benefit against your late spouse's, make that call. The same goes for the IRMAA appeal through Form SSA 44. If a past life event pushed your reported income up temporarily. But there's one more thing specific to this group that almost nobody talks about. If your monthly income is on the lower side, roughly under $1,800 a month for an individual, you may qualify for a Medicare savings program through your state, which can pay some or even all of your Part B premium for you. These programs exist specifically for people in exactly this situation. And most eligible seniors never apply simply because nobody told them the program was there. If that could be you or someone in your family, contact your state Medicaid office and ask directly about Medicare Savings Program eligibility. It costs nothing to ask, and it can put real money back in your pocket every single month. There are actually 3 tiers of this program, and the income cutoffs matter. The Qualified Medicare Beneficiary Program covers the most. Your Part B premium plus deductibles and coinsurance for the lowest income levels. The Specified Low-Income Medicare Beneficiary Program and the Qualifying Individual Program cover just the Part B premium at slightly higher income levels. The exact cutoff shifts a little by state, which is exactly why the right move is calling your state Medicaid office directly and asking where you fall, instead of guessing based on a number you saw online. If you're helping a parent or older relative in this group manage things, it's worth checking whether they have a trusted contact listed on their My Social Security account and whether their address and direct deposit details are accurate. If someone ever becomes unable to manage their own benefits, SSA has a representative payee process that formally lets a trusted person step in and handle things on their behalf, and it's a much smoother process to set up before it's urgently needed than after. For this group specifically, a missed survivor benefit tends to be the largest in dollar terms, simply because it's had the longest time to compound. A $300 monthly gap missed for 15 years is $54,000 that never should have gone unclaimed. None of these checks require a lawyer, an accountant, or a fee of any kind. Just a phone call and a little patience on hold. Now remember Diane, the viewer I told you about earlier? Here's how her story ends. When she finally called SSA and asked them directly to compare her own retirement benefit against her late husband's record, they found she qualified for a survivor benefit that was $460 a month higher than what she had been collecting. SSA didn't just fix it going forward, they backdated the correction and sent her a retroactive check for the difference. It took her 15 minutes on the phone, 15 minutes, for hundreds of dollars a month, for the rest of her life. She told me the hardest part wasn't making the call, it was not knowing to make it sooner. That exact fix is sitting there, unclaimed, for a lot of people in groups 3 and 4, and it starts with one phone call that most people never think to make. So here's the summary, group by group. If you were born between 1967 and 1975, know that your full retirement age is a flat 67. Understand what a 30% early cut actually costs you in real dollars over 20 years of retirement. Check your earnings record on ssa.gov while the paperwork to fix it still exists. And if you're married, run your claiming numbers as a couple, not just alone. If you were born between 1957 and 1966, know your exact full retirement age down to the month, not just 66 or 67. Understand exactly how much an early claim costs you at your specific birth year. Check the spousal benefit option if you're married, and if you're working while collecting before full retirement age. Understand that withheld earnings, test money is not gone. It comes back to you once you hit your full retirement age. If you were born between 1952 and 1956, remember that delayed credits stop the day you turned 70. So file now if you haven't. Get SSA to compare your benefit against a late spouse's record. If that applies to you, check whether you're overpaying on Medicare through IRMAA, and confirm someone in your household is actually opening that December COLA notice every year. And if you were born in 1951 or earlier, do that same survivor benefit check. Look into the IRMAA appeal. Ask your state about a Medicare savings program if your income is on the lower side. And make sure a trusted contact and accurate direct deposit information are on file, both for your own peace of mind and for whoever in your family might need to step in one day. None of these checks cost anything. All of them take one phone call or one form, and every single one of them is worth more than the few minutes it takes to make. If this applies to you, or to someone in your family, don't just save this video for later. Share it with them directly right now, because the SSA is not going to call and walk anyone through any of this. Somebody watching this today is sitting on money they don't know is theirs, and the only thing standing between them and that money is finding out which group they're actually in. It might be them, it might be their parent, it might be someone they haven't talked to about this in years. Send it anyway. Subscribe, turn on the bell, and I'll see you in the next one.